Welcome to DrJLT Economics. I'm Dr. Julian Tong. In today's episode, I want to discuss a phenomenon that I think could happen in the upcoming economic crisis. And this is the coexistence of inflation and deflation, perhaps particularly in the United States. Let me explain. Normally, when we think of inflation, we think of rising prices or a increase in the money supply, and in deflation, we think of lowering of prices and a reduction in demand, right? And these things, seemingly, they cannot happen at the same time. Of course, all the features of inflation and deflation cannot happen at the same time. But there are some peculiarities in this current crisis, in this upcoming crisis, that I think could actually make a large portion of the features of both inflation and deflation happen at the same time. Why is this the case? Well, actually, before I go in there, I want to just provide a little bit of motivation why I think this could be an interesting topic. This is because I watched a video of people discussing, debating whether the upcoming crisis is going to be inflationary or deflationary. Now, I think there's really a distinction without much of a difference. And the reason I think this is so is because we are in this, the United States is in this peculiar state where it has the world's reserve currency. Historically, trade has always been based on some commodities, right? It's either gold or silver for centuries, and then it had been currencies that are at least partially backed by gold. It was only after the 1970s where the world were using the US dollar as the world's reserve currency, but at the same time the dollar is not backed by anything. It was completely backed by the confidence, which was fiat. And this is a new experiment, so it would not be surprising that some of the new economic phenomenon could emerge as a result. So this is one of the reasons. And secondly, the United States has been doing what is called quantitative easing in a large scale, and it's only accelerating. They have been doing this as a means of rescue plans or stimulus. But the fact of the matter, if it has not been clear to anyone, is that this does not work. If it had worked, the economy of the United States, over a decade after the initial crisis of 2008, if it had worked, the economy would have been better. They would have, they would have been not needing stimulus, or they will be needing less stimulus. But the reality is that they are needing more stimulus, and each time they need the stimulus package to be bigger in order to sustain not even a growth, not even much of a growth. If you look at the last decade, the United States didn't grow much. Nominally, perhaps it had grown some, and certainly better than the European Union. But if we deduct the inflation, and I don't mean that we should look at CPI, which is a manufactured index to show that there is no inflation, but if we look at inflation in terms of commodity prices, if we look at inflation in terms of the increase in monetary supply, we will see that they have not had much growth. In fact, if it weren't for all the money going into the asset market, the stock market, beating up the stock prices. If this money has been circulating, we would have observed a higher inflation and perhaps even higher inflation number than the growth number. So basically, the economy had perhaps even been shrinking. So certainly the stimulus does not work even in the midterm. In the short term, perhaps it works to some degrees, but it's not. It is basically a way of basically taking away your future in order to finance the present. That is basically what this type of quantitative easing stimulus is about. Now, so with these, under these circumstances, I think we could observe something that is very unique. So let's just deduce a little bit. If from a couple of different scenarios, either we start to observe some debt deflation, or we observe some inflation, runaway inflation, and inflation that is above 2-3%, that the Federal Reserve cannot has to deal with, faces the decision that whether to deal with it. So let's look at these scenarios. First, let's look at debt deflation. Now, it is possible, right? We now have this bubble in across the world, and particularly in the United States, that this bubble has led to a tremendous growth in corporate debt. Not just, I don't even care about the national debt, but let's look at the private debt and corporate debt. And these debts have faced the problem that compared to the U.S. government, they can always roll over their debt. But companies can't always roll over their debt. And if it comes to such a scenario where there is a bubble burst, where people decide that this is too insane, the stock market has it weakens, the bond market weakens. What could ensue is that a lot of these companies who have more debts than assets, than equity, will basically have negative equity, and they can go into bankruptcy. And this could lead to an increase in unemployment and a decrease in demand. So this would lead to a classic deflation, right? And the problem is that the Federal Reserve now has zero interest rate and is already doing QE. And if under these circumstances we have a deflation, what will be the monetary policy that the Federal Reserve Bank can undertake to combat these events? What they possibly will do, I guess, will be perhaps to go into negative interest rate, right? And this, I think, is quite dangerous because the United States, has greatly benefited from the fact that it issues the world's reserve currency. But if the US dollar has negative interest rate, if at the same time the economy is so bad that they're in a stagnation with that deflation, what will the foreigners, foreign central banks and other investors, foreign funds who hold US dollars, US treasury notes, and whatever, all assets that's denominated in US dollar, what are they going to do? They will see this as a very dangerous situation. They want to avoid this risk, and what they are going to do is they are going to exit US dollar. And as they exit the US dollar, the US dollar, the purchasing power of the US dollar, the price of the exchange rate of the US dollar, everything will come down, right? This will lead to inflation. So what starts as deflation will lead to inflation, and basically we will have both deflation and inflation. The deflation in the asset market, in whatever bubble that had been, and inflation in the US dollar and in the purchasing power of the US dollar. That's one starting point. Another starting point is simply that the continuous stimulus packages and quantitative easing, never stopping acceleration in money printing. At some point, if it can increase the inflation and reduce the purchasing power of US dollar to such a degree that we start with some inflation. We start to see inflation getting a bit high, and a lot of the foreign investors will start to demand, not just foreign investors, but also a lot of domestic investors from the United States will start to demand that the Federal Reserve intervene. And the Federal Reserve faces a couple of choices. Will they intervene or will they not intervene? If they are to intervene, then they will have to increase increase the interest rate, and because this will likely be a bit late after having printed trillions upon trillions upon trillions of US dollar. What's likely going to happen is that a small increase of 50, 100, 200 basis points is not going to have any significant effect. So what they're going to do is, they have to, they need to increase the interest rate very, very high to 10%, to 15%. To have some effect to come back to the inflation. But that is going to cause the bubble burst, because the bond market is going to be destroyed by this. And the stock market is also going to get destroyed by this. So what is that? That becomes kind of a deflationary scenario. So you can have an inflation in the U.S. dollar and a deflation in the the bond market and in the financial markets. Alternatively, the Federal Reserve can choose not to intervene. But if they choose not to intervene, then we have just increasing inflation. And of course, this is the only case that I can see where there is no elements of traditional deflation in the traditional sense. It will be a dissipation of de facto default on the obligations of obligations that is denominated in US dollars, whether it is household debt, whether it's corporate debt, whatever debt, that as long as it's denominated in US dollars, if there's hyperinflation in the USD, these debts will be wiped clean. And this basically is the only scenario where there is no clear traditional sense of deflation. But it still is going to be very painful. I think perhaps even the most painful outcome. Now, what can the Federal Reserve do? That's a very interesting question. I think what they can do, what they should do for the interests of the United States, and really it's only for the interest of the United States, it's not for the interest of anyone else, would be to stop quantitative easing immediately, would be to cancel all those stimulus nonsense, and this will be from the US Congress. They would have to cancel all the stupid stimulus nonsense. they would have to cut their spending, especially in their military spending, to cut down their military bases overseas from like close to 1,000 bases to under 100. They need to reform their tax systems. All these things, anyways. I'm just talking these things. I think that's never gonna happen. But there are still ways that they can address this, right? There is this speech, I think the third Philippic, which is very famous speech from 341 BC. It has this line where this the speaker Demosthenes said this. Let me just read it to you. It is a strange thing, perhaps, that I am about to say, but it is true. The worst feature in the past is that in which lies our best hope for the future. And what is this? It is that you are in your present plight because you do not do any part of your duty, small or great. For of course, if you were doing all that you should do and were still in this evil case, you could not even hope for any improvement. So this is the quote. And I think the United States, having still a great advantage in technology, it still is the world's largest economy. It still has great education, higher education system, and it still has a relatively hard-working people. Having these great assets, and also the United States also has the asset of still holding the world's reserve, still issuing the world's reserve currency, and it also has population structure that is less deflationary than elsewhere. So it is equipped, if the Federal Reserve and the U.S. Congress were to act responsibly, it is equipped to avert all these stagnating all these stagnation, all this destruction of this upcoming economic crisis. I think the region that is really doomed is the European Union. But America could still go on, but not with quantitative easing and stimulus. As long as they continue on this path, in the very near future, they will face one of the two dilemmas that I just talked about. And in either case, they will face a combination of deflation and inflation, and there is just simply no good way out. There is no way out if we reach that tipping point. And the only end game from that would be the US dollar stop being the reserve currency because of the inflation. Because of inflation, it will cease to be the world's reserve currency. And it will also, but afterwards, I have to say, there could be a rejuvenation, an opportunity for the United States to rejuvenate itself. If it can refine free market capitalism, if it can go back to a version of free market capitalism without big government interventions, without the nonsense of printing money, if they have sound money and sound non-restrictive and not so heavily intervened economic policy, then I think it is possible for the United States to continue to be one of the most vibrant economies in the future. But currently, because of quantitative easing, because of continuous non-stop stimulus, the United States is basically a drug addict. It's become less and less efficient, and it's losing this game. So I think very likely the United States will lose its reserve currency status, the reserve currency, treasured reserve currency. And that will be the end of the Federal Reserve as the world's reserve bank. And I think we will be better off, the rest of the world. Thanks for listening, and I wish you a great day.